Now continuing with the same question, a company purchased a machinery for rupees 8 lakh on 1st July 2005. It is to be depreciated at 10% on original cost. Again, original cost implies straight line method. On 1st April 2006, this asset was sold off for rupees 5 lakh 50,000. If the accounts are closed on 31st December each year, show journal entries. Now students, mark this, you are not required to prepare machinery account, you are just required to show journal entries. So starting with it, on 1st July 2005, we have purchased a machinery. Since we have purchased a machinery, entry would be machinery account debited to bank account. Again, machinery is a real account, debit what comes in. Bank is a personal account, payment would be made, so credit the giver. The amount would be rupees 8 lakh. Narration would be being machinery purchased. Now students, at the end of this year, the year is ending on 31st December 2005. At the end of this year, depreciation would be charged. So the entry would be depreciation account debited to machinery account. Narration would be being depreciation charged on machinery for 6 months. Why 6 months? Because you had purchased it on 1st July and on 31st December you are charging depreciation. So 10% of 8 lakh for 6 months comes to rupees 40,000. Now students, on the last date, that is on 31st December, depreciation is an expense, so it should be transferred to profit and loss account. Profit and loss account debited to depreciation account. Narration would be being depreciation charged to P&L. Charged to P&L account, and the amount would be rupees 40,000, as we had charged depreciation of rupees 40,000. Now these three entries would be done in year 2005. Coming to year 2006. Coming to year 2006. Now in this year, it is clearly mentioned that on 1st April 2006, this asset was sold off for rupees 5,50,000. Now students, the year is beginning on 1st January, as the previous year was closed on 31st December 2005. So this asset has been used for 3 months, that is January, February and March. So on 1st April 2006, the first entry would be to charge depreciation on this machinery for 6 months. So entry would be depreciation account debited to machinery account, and the narration would be being depreciation charged for 3 months. 3 months. Which in this case would be 8 lakh into 10% into 3 by 12 and comes to rupees 20,000. Now on this date, this particular asset has been sold for rupees 5,50,000. So on 1st April 2006, since the asset has been sold, the entry would be bank account debited to machinery account. Being machinery sold. Now students, bank account debited because it's a personal account, debit the receiver. It is not mentioned here that it has been sold through a check or something, but it is assumed that companies usually make transactions through checks. But otherwise, you can also write cash here. So in this case, the amount would come to 5,50,000. Now students, we have to calculate profit and loss. For this, we'll prepare this working note. Book value on date of sale. This asset was purchased for 8 lakh. 40,000 depreciation was charged during the first year and 20,000 during this year. So the book value of the asset comes to rupees 7,40,000. Now students, this assets or this machinery that is worth rupees 7,40,000 has been sold for 5,50,000. So it clearly shows that there is a loss of rupees 1,90,000. So on this date, it would be transferred to profit and loss account. Profit and loss account debited to machinery account 1,90,000, and it would be being loss transferred to profit and loss account.